For some unknown reason, this stuff isn't taught in schools. Leaving school, I could tell you all about a goldfish on a bike in my very best French, but I couldn't tell you a thing about investing or the stock market. Le poisson rouge dans la bicyclette, in case you're interested. God, I hope I got that right. Maybe you've clicked this video because you've heard your friends and family talking about stocks and you've no idea what they're talking about. Maybe Freddie's been bragging again about how much money he's made, or Julie's been weeping into her wine about how much she's lost this year.
Or maybe even worse, you've made a social faux pas when out with friends when hearing them talking about the FTSE, you thought they meant something else entirely.
Well, let's start at the very beginning, shall we? And answer the question, what is a stock? Hello everyone, my name is Tom Morgan from the YouTube channel That Finance Show, and I'm also a fully qualified financial advisor and planner based here in the UK. Today I am coming to you in collaboration with the good people from Trading 212 who want to help you get smarter when it comes to investing. Seeing as we've been talking about school, let's take a quick history lesson, shall we?
Our story begins here, in Amsterdam. It's the 1600s and the Dutch East India Company are looking to expand their empire. They want to run more voyages and bring back more luxuries from the East, but they need to raise capital to do it. They decide to issue what's thought to be the first ever stock in their company. This meant persuading willing investors to give them money in exchange for a part ownership in the business and the profits that it might make moving forward. This eventually would lead to the birth of the very first stock exchange, where people would buy and sell stocks and shares, and if we roll forward to today, instead of just having one company to choose from, it's a very different story indeed.
If you want the official definition of a stock, Investopedia defines it like this.
A stock, also known as equity, is a security that represents the ownership of a fraction of a corporation. This entitles the owner of the stock to a proportion of the corporation's assets and profits equal to how much stock they own. Units of stock are called shares.
This highlights something worth noting right from the start. The terms stocks and shares are almost one and the same thing, and they are used interchangeably. And if you're anything like me, seeing a written down definition like that doesn't always go in. I find an example is much better.
This is George. George is sick to death of his boring 9-to-5 and spends his evenings working on his business plan to launch his own company, making and supplying his unique pies to restaurants, pubs far and wide, and eventually he hopes they will be on supermarket shelves up and down the country too. He's been tinkering with the recipes for months and is confident people are going to love them. Now, the challenge is, in order to make this business a reality, he needs a premises, kitted out with pretty high-end kitchen equipment, along with a few members of staff to help him, and a marketing strategy just for starters. And all this costs money. That's okay. George has been saving away the money from his monotonous 9-to-5 and has managed to get together £5,000. A good start. The problem is, his calculations show he needs £50,000 to get started. George decides he doesn't want to go to the bank and get a loan because he doesn't want to have to pay interest and be on the hook for big monthly repayments. He decides instead to issue stock in his new company to his friends that are always talking about investments whenever they are together.
Now remember, George has £5,000, so he needs another £45,000 to get to the £50,000 target to launch his pie empire. So he's got 10% of the money, and now all he needs is the remaining 90%.
So George proceeds to deliver a once-in-a-lifetime pitch he's laboured over for weeks to his friends. He tells them that this is a once-in-a-pie-time opportunity, and they'd be mad not to want a slice of the action.
Sorry, no more puns.
He talks them through the numbers, his plans for expansion, and the money they could make together. This was real, he tells them. This is not just a pie-in-the-sky idea.
Sorry, that really is the last one.
And it works. 9 of his friends each decide to give him £5,000 to match what George is putting in. And in exchange for this, they will each have an equal 10% share of the company and its future hoped success.
Let's roll forward, say, 5 years, and I'm pleased to say that George's pie empire has been a roaring success.
He's now got numerous premises, a large team of chefs and office staff, and deals with loads of local restaurants and supermarkets. His accountant calls him in to tell him that the business is now worth £500,000.
But remember, George had to give away 90% of his business to his investor friends. So he only owns 10% of this business and its value. But that still equates to £50,000. And seeing as he only put in £5,000 of his own money, that's quite the return on investment. And what's more, he didn't have to take out a bank loan, pay any interest or hefty monthly repayments. George's friends are happy too, because their shares are also worth £50,000. So yes, George had to give away 90% of his business, but a smaller piece of a much bigger pie is better than 100% of nothing. I feel like there's a pie pun I might have missed in there somewhere. Another way that George could reward his investors, on top of the growth of the value of their share, is through something called dividends. Dividends are simply regular payments made to shareholders out of company profits as a thank you for investing. Some companies pay them and some don't. But how likely is it that your mate George is going to come to you with some mighty pie empire deal which would see you make a 900% return on your money over, say, 5 years? Yeah, pretty unlikely. You're much more likely to be looking to buy shares listed on a public stock exchange. Today, that is where most shares are bought and sold. When companies become a more serious size and they're looking to raise more capital, they can do something called an initial public offering, or IPO for short. This is where a private company sells its shares to the general public, and thereafter they are traded on a stock exchange. And it is here, in this stock exchange trading, that you are much more likely to be getting involved as a new investor.
Jumping on the Trading 212 app and looking at the popular stocks section as an example, we can see companies such as electric car giants Tesla and the mighty Apple as examples. These are big businesses that you can buy shares in if you want to, and are certainly easier to get your hands on than shares in George's pie shop. Going into Apple as an example, you can see the current share price here, the recent ups and downs of that share price here, and if you scroll down, it will even tell you what the dividends you might expect could be, amongst loads of other info, which are all topics for another video, another day.
Remember, stock prices are driven by profit, and like I said at the very beginning of this video, investors buy stocks for one very simple reason: to make money. My name is Tom Morgan from the YouTube channel That Finance Show, coming to you today in association with Trading 212. I really hope you found that video useful, but before you go, there's 2 things I need from you in the comments below. Number 1, please give us ideas for future topics you'd like covered in these videos. Perhaps there's some investing term that's always baffled you, or something you've just never fully understood. Please let us know. And number 2, I never could quite come up with a witty name for George's pie empire. Best suggestions below. Most likes wins. Give the video a like if you learned something, and please subscribe to the Trading 212 YouTube channel with notifications turned on so you don't miss any future uploads. And if you're feeling really kind and you're already using the Trading 212 app, please head on over to the App Store or Google Play, where you can leave us up to a 5-star review to let others know just how good it is. Until next time, au revoir. Bye.